Berkshire Hathaway, the largest hedge fund on the world, led by legend Warren Buffett, has just released its Q3 results, marking a significant change in Warren Buffett's investing style. These changes are particularly important if you are a person that is investing in dividend stocks or the US 500 all-cap index. Berkshire Hathaway has been making a lot of purchases over the last 4 quarters, with its cash flow going from a staggering $85 billion, more than the entire net worth of the company when Warren Buffett was 65, to $29 billion, spending $56 billion in 4 quarters. If you're wondering whether you should be buying now, there's a common trend in what Berkshire Hathaway is buying that I think should impact your decision as to what stocks you buy and at what price. Looking at the stocks being purchased by Warren Buffett's Berkshire Hathaway, I think one of the things that is driving these purchases is the rise in share buybacks.
In the fourth quarter of 2019, companies on the S&P 500 spent an estimated $189 billion buying back their own shares from the stock market.
Share buybacks at their core is a way for a company that has a surplus of cash to return value to shareholders while avoiding paying tax. And this in contrast to dividends, which you get taxed on, but also it decreases the value of each share since you have less cash per share. In fact, 2 out of the 3 purchases in the last quarter had far above average the amount of share buybacks that you'd typically expect. Apple and Louisiana-Pacific Corp have been doing an astonishing amount of share buybacks. While Apple has bought back around 20% of the company, Louisiana-Pacific Corp have bought above 30% of the shares back in equity. This means that if you are earning £10 per share without doing anything, without even increasing revenue, you are now earning over £13 per share. Buybacks are just one aspect of a company, and Berkshire has done trades that go against this narrative. However, it does seem to be a trend across his entire portfolio in the acquisitions looking back over the last few quarters, especially in the wake of the pandemic, where a lot of companies have found themselves with a surplus cash supply and an incredibly hard market in order to know where to invest it. This presents a problem for dividend investors and those waiting to buy in at the right price on the US 500 all-cap index. Dividend stocks could become less appealing to institutional investors, which could lead to a better value for dividend stocks going forward. However, it could also lead to dividend stocks cutting their dividends entirely. This happened to General Electric back in 2004. At the time, it was the world's largest company. It was a shining example of capitalism.
The origin story of GE is fascinating and involves legends like JP Morgan, the man, Thomas Edison, who, has over something like 1,000 patents, Charles Coffin, and others. How did they all come together to create what ultimately became a company synonymous with America itself?
And suddenly the company's earnings turned out to be not as stable as everyone thought they were, and the share price collapsed, and the CEO of General Electric had to cut the dividend out entirely. The share price went from $40 per share to $7 per share and has performed terribly over the last decade. This was the best company in the world at the time, and it just goes to show that you just can't trust dividends, and dividends might not be the financially sensible decision for a company to do. So don't take dividends on face value. Try and evaluate a company for its worth, not for its dividend. For those waiting to invest in the US 500, the problem here is simpler. The common tool to use to value the S&P 500 is the Sh/P ratio, and share buybacks are currently breaking it. Historically, those who have followed the Sh/P ratio have done incredibly well. In the 2000s, the Sh/P ratio pointed out that the S&P 500 index was enormously overvalued, and the creator himself sold out of the S&P 500 index to prove a point and was proven right. The S&P 500 collapsed in the 2000s. In 2008, the opposite happened. In 2008, the price to earning ratio was at an all-time low, and after a terrible year of earnings. However, the Shiller PE ratio showed that the historical earnings of the stock were incredibly cheap relative to the current price. If you bought in 2008, you would have bought at an incredible bull run, an incredible opportunity. While those who followed the Shiller PE ratio historically have done really well, the creator himself has pointed out the flaws. The fact is, the Shiller PE ratio needs to account for share buybacks, which it currently doesn't. And while there are an enormous amount of share buybacks, the Shiller PE ratio may appear high. However, the earnings per share have potentially gone up significantly. The frustrating thing is there is not currently a ratio that I know of that takes into account share buybacks. So if any of you know of a calculation that does this, that would be great if you could leave it in the comment section below. Until then, will I be buying the S&P 500? Yes, I will be buying it monthly as I always do. However, I do have a significant cash supply at the minute, and I'm holding off putting it into the S&P 500 just because I can't bring myself to purchase something that I currently deemed overvalued. I need to see how the business, how the index fund is affordable or priced well in order to invest more money, even though history would tell you the most rational thing to do is to put as much cash as you feel comfortable with, or as much cash as possible, into the index fund. It's still reasonable to not buy things that you feel are unaffordable. This approach may not be mathematically perfect, but it's reasonable and will allow you to make informed decisions based on the risk that you are comfortable taking. Thank you very much for watching. Subscribing and liking is free. Goodbye.